Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 5th of February, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. We're going to go through our slightly different run through in here today for a Monday, in that we're going to take a look at the shape of the week. But we'll run through the macroeconomic fundamentals, central bank, geopolitical events and earnings events as well that are shaping financial markets right here, right now. But we'll do it as a slightly bigger outlook for the week. Yes, I know we're day trading at trade day, but having a good understanding for the shape of the week, where the volatility points are potentially coming at different points in the week, will give you a better idea of how maybe things are going to, the market's going to react today and how volatility might be today. So you might want to adjust your trading approach depending on the what I like to call the shape of the week. Just a heads up that our usual macro matters is live right below where you are right now. So in the research area, just below where, if you're watching this live, guess given you're not watching it on YouTube, but if you're watching it in our members area below where you are, the macro matters as ever is uploaded at the weekend, usually on a Sunday. So that's the more in-depth look in here, and you can take a run through of everything that's been going on in the markets from a macroeconomic fundamental central bank perspective over the last week. Also looking here at the earnings reports that we had from the big tech companies, and then also looking ahead to what we have this week. As well as getting that more in-depth look, we also publish the weekly update in here, the recap and update. And in the weekly update, we get a far more condensed version of pretty much what is in the macro matters. So we're going to quickly run through that to look back and look ahead. So just looking back, obviously stocks surged higher again last week. Mixed results from the big tech in here, but overall positive from big tech, and then a positive after the US employment report, despite the fact that we saw the initial sell-off, as we said before, on Fridays, TGI Friday Bull versus Bear webinar, I mentioned that the market has been reacting, what you would normally, not as it would normally move, right? So to data, so sort of counterintuitively. So what we've been seeing more recently, and I highlighted this might happen on Friday, is that strong data is taken as negative by the stock indices, not because it's bad for the economy, but strong data meaning that the Fed may not be so dovish, meaning not cut so quickly or aggressively throughout 2024. And if that happens, then stocks don't like that, because stocks have got an expectation that, or did have an expectation that we'd have 5, 6, up to 6 interest rate cuts this year, when the Fed had previously told us they're going to be fewer than that. So positive data could see the Fed stand more resolute and the market be wrong and the Fed be correct. Okay, and so that's certainly what we saw on Friday. So we had a much better jobs report coming at 353,000, way above estimates, nearly double estimates, which were around 180, 185,000. And initially the market sold off. So we saw a sell-off on stocks, on stock futures. And then actually once the cash market opened, the market clawed back higher, because then there's sort of, the knee-jerk reaction is, well, this is bad, because of the Fed are going to be less dovish. But then the market's, well, but it does mean the economy is still strong. And on the back of the fact that we'd had pretty good data through the week. So it's kind of mixed on some of these big tech, but mostly in here higher. We had Meta, Amazon, and Microsoft all did well last week. Apple and Alphabet were on the negative side, but the net was seen as positive. And that on top of this jobs data saw stocks end up higher. And we made new record highs on the 3 major indices, the S&P, the Dow Jones Industrial Average, and the NASDAQ last week. Now, for some reason, I'm getting the pinwheel in here. I'm hoping I'm still streaming. You can hear me okay, guys. If I'm breaking up or anything, please do let me know. And yeah, I had some dodgy connections, as I had on Friday as well in here. So, but the net impact was global stock indices were higher, US averages at record levels. US and European yields generally chopping, but they moved lower through the week, but then reversed higher. So we went to higher yields. Why did we go to higher yields on Friday? Because of that positive jobs report. Higher yields, because the anticipation is the Fed won't be as dovish. So we went to higher yields. on Friday after that data, and we've gone still higher this morning, higher yields, and stocks have been on a slightly more negative footing because of Powell's interview over the weekend, which we didn't put in here because this was published before Powell's interview. We'll talk about Powell's interview shortly. So going into this week, what are we focusing on? Well, the actual on the central bank side is fairly light. We do get the RBA, the Reserve Bank of Australia, on Tuesday, so maybe we'll keep an outside watch on that. But we're going to be really focusing on any Fed speakers as we come up. Very much Fed speaker watching is going to be what we're doing this week. On the data side, it's fairly white. The main data of the week will come today. We've already had global data from Asia and Europe. On the services and composite PMI data. We get the US data later today. We'll take a focus on that shortly. And most of the big companies are reported now. We still do have a series. We're halfway through reporting season. All of the big tech is done and out the way, and they obviously, the Magnificent Seven, have all reported. So they are clearly are the big drivers of the major indices. We do get any of the standouts this week: McDonald's, Eli Lilly, Uber, AstraZeneca, and Pepsi. So if we go and take a look at the table in here, you can see global services and composite PMI and the US ISM services PMI all come out today. That's really the big focus for the week. RBA, as I say, tomorrow. EU retail sales also tomorrow. Nothing really of note Wednesday. We get China inflation data on Thursday is the main standout, and then a German inflation data on Friday, and then the Canadian employment report. And there's the, outside of, I'd say, Walt Disney and Caterpillar, not really looking for too much of any real note that's going to really impact the indices overall. Disney sometimes can move the Dow, so I've seen Disney is still in the Dow, yeah, I'm pretty sure it is. But Disney can move markets, but usually Caterpillar sometimes as well. But let's go take a look at the calendar for today, and the focus going into today is going to be that PMI data. So you can see in here the European PMI data already out for Europe and the UK, France, Germany, Eurozone, and the UK, and you can see pretty much all in green apart from the Eurozone as a whole, which came in bang in line with expectations. So Eurozone PMI data so far has been positive. At 9:45 Eastern, we get also the S&P. So this is from HCOB and S&P Global. We get the S&P Global data at 9:45, but that gets kind of trumped in here by the ISM data that we have on from the US. So the ISM data is seen as the more important data. So 9:45, the S&P Global data, then usually doesn't move markets too much, because then 15 minutes later we get the ISM number. So we're going to certainly be keeping an eye on all of that as we go into today. And then overnight we get the RBA interest rate decision. Moving on to the earnings calendar, to say there's nothing of real significant big note in here. We did get Caterpillar out of McDonald's already today. Caterpillar beating expectations. Caterpillar often seen as a barometer for the US and to some extent the global construction industry. So that's a positive that we've seen them beat expectations. And I say the main focus is going to be later in the week with Walt Disney. I say is the main one we're going to be watching for as we go through the week. Just looking at the headlines in here. From LiveScoop, again, you can get these European, US, and Asia briefings below where you are now. On the right-hand column, there's the news briefings from LiveScoop, and you can see the main thing in here they're focusing on is yields going higher because Powell was fairly hawkish, really. In the 60 Minutes interview that he had on Sunday, and basically said, I think he pretty much indicated that they were only going to be cutting rates but 3 times this year. With the economy strong like that, we feel that we can approach the question of when we begin to reduce rates carefully. So not coming soon. So March is getting pushed back, as you know, that we're not going to get the first cut in March, and potentially only 3 rate cuts coming this year. And the market, remember, was looking for 6. So if we go I'm going to... I've already looked at the calendar there, haven't I? Yeah, already gone through the calendar. So let's take a look at, as we look through the headlines in here, 5 things you start to know your day. Powell, shockwave, sell-off in US Treasuries that we saw on Friday extending. Powell said the central bank is wary of cutting rates too soon on the CBS 60 Minutes interview in here. Speaking of cutting rates too soon, the team at the OECD is looking along similar narratives, so they're not looking for any coming soon. Chuck worries on China. Tumbling stocks in China, also added by fears in China because of potential Trump winning the November election. Before, when Trump was in power, there was basically a trade war with China. So, And Trump has said in a Fox interview he might impose a tariff on Chinese goods of more than 60%. So that's obviously not good for China in here. And then we don't need to look at this stuff about Chevron and Exxon numbers in here a bit in the past, and then looking into the head. Today we're looking at the ISM PMI numbers. So Treasuries extend slide on Powell's, and stocks are mixed. Stocks not really getting hit too badly, even though he was fairly hawkish in here. But we certainly see Treasuries continue having sold off on Friday after that US employment report because of an anticipation of a less dovish Fed. Then that's being added to this morning by the fact that we've seen after Powell's comments in here. But UniCredit jumped 7% after they beat profit. So looking at some of the European numbers in here, European stocks are actually up this morning, also being helped by those numbers that we looked at, those PMI numbers beating expectations. Oil also lower on the Fed rate cut outlook in here, dense geopolitical premium. So and US forces hit Houthi sites in Syria. So even though we're getting some kind of ongoing tension, crude was down last week in its biggest decline since October, and down again in here because of Powell, basically saying fewer rate cuts, and so that means then potentially not fueling as strong a global economy. So oil down. Powell takes Fed cut pushback to the masses. So that's the TV interview, obviously being on 60 Minutes. Bond market rate cut bets rattled by Powell pushbacks. That's all the same stuff in here. Morning bid from Reuters. Powell prudence spurs a sell-off in bonds. Not too bad in equities though. But if we look at the bond market in here, you can see we're already at that, but we shot higher. Here's the US 10-year yield when it loads. Why is it not loading? Load. But US 10-year yields, when it does load, we can look at the prices. We have to jump to the... Let me jump to... Oh, here we go. I'm going to jump to the CME tool while that continues to load. If you look at the CME tool in here, so going to March, you can see how this is shot up now, 85% for unchanged in March. Only a 15% chance of a rate cut now in March. And if we go to May, this is faded slightly. So now the market now only 35% chance. We're still unchanged in May as well. Okay, so that's worsened significantly. And if we jump to the end of the year now, remember we looked at this just last week. So we're currently 525 to 550. Well, we had 150 basis points. 6 rate cuts was the bet that we were going to go to, which is 375 to 400. Okay, now there's only a 20% chance. This was much higher. So this was much higher, and we had more rate cuts built in by the end of the year. Now there's only a 20% chance we're going to have 6 rate cuts by the end of the year, is what the market is telling us in here. With the bets more that we're going to get 5 rate cuts. The sweet spot is here. This is 5 rate cuts. So the market's backed off just since Sunday, just since Powell's, since the US employment report plus Powell, both kind of effectively hawkish events for the bond market and for the potential for rate cuts. Now, the stocks have done particularly well, in my opinion. If you go look at hopefully this is loaded by now. There you go. So there's the big push higher. So we've been going down lower in yields in here throughout last week. But then what we saw on Friday was a reversal back higher on the US employment report, higher yields because we think the Fed are maybe not going to be as dovish, and then higher again this morning on the back of the Powell interview. If we go and look how it's impacted into Asia in here, Hang Seng very little unchanged here, despite those comments from Trump in here. The Nikkei is actually up 0.5% with basically following the US that was higher, remember, from Friday. European stocks are actually slightly up in here. The UK FTSE is up nearly 0.5%, German DAX 0.25%, with the French CAC index little change in here this morning. And if we go and take a look at the US, if it loads, so we were obviously up healthily up on Friday despite the initial sell-off after the US employment report, but you can see slightly wobbling lower in here this morning, not much lower, but on the back of those Powell comments from the 60-minute interview, we're about 1/10 lower on the Dow, nearly 2/10 on the S&P, and pretty much unchanged though on the Nasdaq, which is fairly solid really. If we look at the reports that you've got below you, my technical analysis reports of market charts, stock still obviously bullish, despite the kind of slight little wobble overnight in here going into this morning. We had a strong push higher to new highs, so nothing to expect more than higher higher stock index prices. But we did see a significant sell-off in here. This is the 30-year, but more significant at the longer end. So the 10-year big sell-off, and obviously we're lower again in here this morning. So we turned bearish in here on the bond markets in here mostly, apart from the 30-year, and we'll probably go bearish now. We've got that further sell-off in here going into today, so probably turn bearish on that as well. Very, very, very quick look at the charts in here, if they load. Sorry, these were all loaded up earlier on. But basically bullish on stocks. If this doesn't load, guys, I'm just going to skip over it because we've been going for a while. Okay, we're loading up now anyway. So in here, you can see if we go to the daily on the ES, we got push higher, big push higher back on Thursday. Kind of choppy on Friday, and that was through the data, initial sell-off and then a rebound and a slight setback from the highs, but holding in pretty well in here. On the 30-minute chart, we can see in here in the market, there's the sell-off in here after the data. We sold off at 130, then a strong rebound in here going to new highs. Yes, we have dipped back lower after that. So that's basically when we reopened in here with the 60-minute interview, but holding in, I think, fairly well. So still pointing higher. And similar story for the NASDAQ. NASDAQ hasn't quite made a new intraday high after the Thursday, Friday rebound, but more resilient in here this morning. I think we can make new highs, if not today, certainly going into tomorrow. Question from Jim: can you explain this announcement re equal weight futures? Yeah, so I think what this is in here, let me just bring it across. Can you see it now? Yeah. So I know you posted this, I think, late on Friday, just as I was closing the webinar, but I did just manage to click it, but I'd already closed out. So they're launching equal weight futures. I don't think these are going to take off, right? I think the reason for this is, exactly what we've spoken about more recently. I haven't really looked into any depth in it, to be quite honest, in here, Jim. But what they're going to do is, I think they're going to basically do an S&P 500 where the weighting of each individual stock is equally weighted, okay? Rather than at the moment, so you have two types of stock index, right? So they're usually either price weighted, right? Or, actually three types of stock index: price weighted, capitalization weighted, and equal weighted. So on a price weighted index, the Dow Jones, for example, is a price weighted index. The index is weighted by the price. So the bigger the price of the stock, right? So not how big the actual company is. So you could have a stock, your stock price doesn't necessarily means the company's big, right? But it's based on the price of the stock. So in the Dow, for example, Boeing has got quite a big price. So Boeing has a very big impact on the Dow because it's got a much larger price than a lot of the other stocks in the Dow. So in a price weighted index, the weighting for each stock, how much it impacts onto the index is weighted by the price. Most indices around the world, not all, but most indices are market cap weighted, okay? Which means the bigger the market cap, how big the company is. The market capitalization is just the stock price by the multiplied by the number of shares. So that's what the company is worth, okay? So the bigger the market cap, the bigger basically the company, the more weight, the more it moves the index, okay? So for example, the S&P 500, the normal S&P 500 is a market cap weighted index, and this is the issue that the what we're calling the Magnificent Seven, right? The big seven stocks in the S&P 500 make up now something like, I think it was hit 29% or 28 to 29% of the overall index, and obviously that changes over time. So you have a massive. So if for example, like last week we have Meta, Apple, and I don't know, Meta, Apple, Amazon, all going up. Actually, last week it was Meta, Amazon, and which was Microsoft, all going up together, right? Then it has a massive impact on the index. So the index gets pulled up much more than it would if we were what they're launching here, equal weighted. So which is weighted based on market. So look, for new weighted advice for your trading strategy, unlike the S&P 500, which is weighted based on market capitalization, the S&P 500 equal weight index adds the same weight to all names in the S&P 500, but new to trade the major ES benchmark. So what it means, it's going to be a separate contract, okay? So it won't be the ES, it'll be something, I don't know what they're going to, does it say what they're going to call it in here? Usually they put what the ticker's called. No, they haven't called what it is, but they'll call it something else, like ESW for equal weighted, or ESE or something like that. I don't know. But anyway, they're going to call it something else, okay? But what it means is that every stock, so the smallest, so there's obviously the stocks are ranked 1 to 500 and how big they are, for example, in market cap. But it doesn't matter. So if Apple went up 1%, or if the I don't know what the 500 biggest stock in the S&P 500 is, but basically almost the smallest stock in the S&P 500 by capitalization. If they both go up 1%, then it has the same impact on the index. Okay, so I hope that makes that clear what a equal weight is. Okay, my opinion is it won't take off massively. Obviously, it's going to move very differently it won't be so swayed by the Magnificent Seven, by the bigger stocks. Okay, it's going to be, but it's probably a better definition of what's going on in the economy. Okay, it reflects the 500 better, right? But personally, I've seen these things launched before. My sort of honest opinion is it won't massively take off. Yeah, it's going to have a lot of funds are going to have to want to be behind it. It may take off over time. It won't take off very quickly, in my opinion. Okay, that's just my opinion. They wouldn't be launching unless they thought there was a market for it. So there's probably demand for the institutional investor, but initially it's unlikely to be that liquid, I should imagine. So just be careful if and when it does launch. Does that make sense, Jim? I said thank you there. Yeah. Any follow-up questions? Make them quick. Otherwise, I'm going to wrap up. Hope that makes it clear, though. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. Remember to watch out for both those PMI data that we have later on today, 9:45 and 10 o'clock Eastern time. And I'll be back with you with another bull versus bear webinar tomorrow. Take care, stay safe, and have a great trading day. Bye.